Today on The Bottom Line, new stock market records and new concerns about valuation, Bitcoin, and David Hunt of PGIM. Hello everyone, welcome to The Bottom Line. I'm Henry Blodget.
I'm Sara Silverstein. A big thank you to Fidelity Investments for making the show possible.
For those of you who watch us regularly, this is a new format. Sarah and I have been watching each other week after week, sometimes saying, how can they say that? And wanting to confront each other about the things we say. Now we're going to do it in person. Lots of great stuff today. Thanks again for joining in. More new highs for the market this week. Seems like every week we have this. How high are we going to go? Does valuation matter at all? If you've been watching The Bottom Line for the last few months, you will note that this is something we talk about quite frequently. I have shown many charts suggesting that the market is extremely expensive. My co-host, Sara Silverstein, and many others have pointed out that that may be so, but it doesn't seem to stop it from going up. Well, a few more points on that this week. One, John Hussman, who has been bearish because of valuation for a very long time, has a new chart that is a variation on the cyclically adjusted PE ratio, where Hussman looks at it and says, look, this has actually now become the most expensive market of all time. Above the 2000 bubble, above 2007, Mr. Hussman is saying that this heralds a likely pullback of about 60% just to get to average. That wouldn't even be a deep pullback. On the other hand, we had Warren Buffett come out this week and say, look, valuation does matter, but when interest rates are low, which they are now, a lot of the old metrics aren't as useful as they used to be. And so a lot of folks took heart in that, and a lot of folks who are bullish say, yes, Mr. Buffett, you are right. No concerns about valuation. Up we go. Mr. Blodget, you are crazy to even point it out. Sara Silverstein, my co-host, what do you think about valuation?
Well, I did see the Hussman chart that you're talking about, and I do wonder if one of the things that he adjusts about the CAPE ratio is he adjusts because the profit margins were so small during the tech bubble. And is it fair to take that out of the equation when you're comparing? Doesn't that make that time more dangerous than this time?
I agree. We can all massage numbers and charts and make them conclude them to look whatever we want to say. That said, it's not just the CAPE ratio that says this market is fantastically expensive. And Buffett, in particular, many years ago, looked at revenue or market cap to GDP, basically said, look, this is the measure that encapsulates everything. That measure suggests the market is extraordinarily expensive, as do many other cyclically adjusted measures. So I don't think that means that we're in trouble tomorrow, the next year. These things can last a long time. But personally, I look at that and say, price matters. Returns are going to be low over the next 10 years.
Timing also matters, I think. And I think that calling the top 2 years too early makes you wrong and costs you a lot of money. In 2005, I remember people saying, credit spreads can't get tighter, they can't stay tight forever. 3 years later, they were still saying the same thing. And that cost a lot of people money, and a lot of people went broke in the process. And Keynes famously said that the market can stay irrational longer than you can be solvent.
You are right again, and I will say that having vocally warned about valuations more than 2 years ago, 3, I do feel like the world's biggest moron. But what I will say is that going back to the 1990s, the arguments you were making, wow, were they everywhere. 1995 to 2000, hey, valuation doesn't matter, it's not useful for timing, so forth. Everyone was absolutely right up until March 2000. Then you began to feel like an idiot while you were impoverished by the return to the mean. And that's what scares me, is that, yes, we would all like to be right on timing, and you were totally right that 2 years in professional money management, you're going to get fired long before you're right. But in the end, if history plays out again, we will be happy at some point that we at least noticed the market's expensive. And
you're right, and you don't want to be the one that's making the argument I'm making right now, right before the bubble bursts. And I think that that's certainly fair. And I appreciate the warning. I think that even though the probability of a crash right now isn't zero, and I am going to protect myself as such, just like when you're in the highway and you see falling rock signs. But I've never seen a falling rock, but I'm glad for the warning. In case it happens, I might be more prepared.
So we will stay tuned to valuation on The Bottom Line.
Yes, and I also would like to share a Fidelity chart, the chart of the week this week, on market breadth, which has been known to show the strength of a market. And the market breadth right now is actually at the lowest point that it's been since before the election, with just 43% of stocks that are currently above their 50-day moving average. So there might be some weakness there, and it's always a nice thing to look at.
A couple of weeks ago, one of the controversies that's been simmering in a corner of the finance world burst into the mainstream. Jamie Dimon, the head of JP Morgan Chase, dismissed Bitcoin as a fraud. He said he would never hire anybody who owned Bitcoin because he wouldn't want anybody that stupid working for him. This was certainly startling to those of us who've watched Bitcoin for a long time. Bitcoin weakened momentarily, but is since coming charging back. And this week, another big bank CEO weighed in on Bitcoin. Lloyd Blankfein said he is, quote, still thinking about it. He's on the fence. So actually, there was a vote of credibility for Bitcoin. We are joined by our cryptocurrency expert, Sara Silverstein, putting together, I should pre-announce a little bit, a show on Bitcoin and others. It's going to be exciting to watch. Anyway, what are your thoughts?
Well, I'm going.
Lloyd, what do other people think about Bitcoin?
Yeah, I mean, I'm going all in on cryptos, and I think that one of the reasons that Blankfein came out this week with his non-decision on Bitcoin is because on Monday they announced that Goldman may be doing some sort of Bitcoin trading operation, which would be the first blue chip firm like that to do something with Bitcoin. We've also heard from Ray Dalio, who told Henry that Bitcoin is a speculative bubble. Jamie Dimon, of course, calling it a fraud. Morgan Stanley CEO James Gorman saying it's more than just a fad, so much more positive from him. Gary Schilling, who I spoke to recently about it, said that it's a black box, and which makes him suspicious, and he doesn't invest in anything that he doesn't understand. BlackRock CEO Larry Fink thinks that the explosive growth of Bitcoin points to nefarious behavior. So we're seeing all sorts of people have different things to say. You have said on both sides, it could go to $1 million or it could go to zero. Where do you fall? Or, to $1?
Yes.
Oh, okay, sorry.
I fall the same place I have been. It is the perfect asset for a speculative bubble. There is a finite supply. It's hard to understand, so there's only a small group that understand it, but now it's sort of reverberating out into the mainstream. It has no intrinsic value, which means, on the positive side, that it could be worth anything, whatever you pay for it. So if you're in early and you're now espousing to the world how much money you have made on your faith, and you can look at it and say, hey, it could go from 4,000 to 40,000 to 400,000 to 4 million. You're right. Nobody can prove you wrong. So that is my view. As long as you are 100% comfortable with the idea that you could lose everything, speculate away.
And I think that that's fair. I think that if you're comfortable losing everything, but I think a lot of the arguments made against Bitcoin that gold has a lot of intrinsic value, to me, the more I think about that, the less true I think it is. I think a lot of that value, the reason we make jewelry out of gold is because it's valuable, it's a safe haven, it's an alternative currency. And I think that a lot of the definitions of a speculative bubble, which are wide-ranging, can be applied to a lot of things, including gold as well. So I'm not entirely sold. I think that people don't understand it as well. I think that that's very fair, and it's not as stable, and it hasn't been around as long. But just because gold exists in a vault, most of us trade it on the internet anyway. So I do feel like people they just don't understand it, but that doesn't necessarily mean that it's not there and real and going to be a real thing.
It's true, and to your point, we do use gold for things. There is demand for it, which holds up the intrinsic value argument, but people are actually using Bitcoin for things too. If you look at the long-term daily transaction of volume of Bitcoin, it keeps going up. And to me, that is actually the fundamental metric that you want to see. If that keeps going up, there will simply be more demand for people holding pieces of Bitcoin, and because there is a finite supply, this is part of what can drive the price up. That said, if Bitcoin dropped to 1,000 tomorrow, lost 75% of its value, there would be no, wow, now it's cheap, get your Bitcoin argument, because again, it could get cut by 99.9% from there, and you still wouldn't be able to argue that it was cheap. That's what I mean when I say there's no intrinsic value.
And I think that that's true. And even if Tom Lee is right, who said that it'll take up a certain amount of the demand for gold as a safe haven, he's not necessarily talking about Bitcoin. So if Bitcoin does lose that much, he's really just talking about cryptocurrencies in general. So it is hard to know like where that would fall, even if you believe that that's true. Earlier this week, Deputy Executive Editor Matt Turner sat down with PGIM CEO David Hunt to discuss everything, including how he also believes that stocks are fairly valued at current interest rates.
So first off, I just wanted to ask, when you look around the world, what do you see?
So for us, the most important thing that we focus on is our investment performance. We believe fundamentally that investors, and most of our investors are long-term, sophisticated institutions, so they're pension funds, sovereign wealth funds, central banks. And what they're looking for from their investors is somebody who's actually going to be able to beat their benchmarks and add excess return for them. So we're an active manager, which, as you know, has been somewhat unpopular of recent. But we believe we've been a very successful one, and we've been successful because we do deliver real excess returns for our clients.
Okay, and in terms of those excess returns, where do you see opportunities for investors? Where are your investment managers seeing an opportunity to make money?
So I would say the major thrust has been threefold. One has been for many institutional investors around the world, the race for yield and the search for yield has been incredible. And we may not love the interest rates in this country, but if you are in Japan or you're in Europe, all of that actually looks really good. And so we've really been able to bring the search for yield home to many of those investors. Secondly, I would say that we've been very successful in finding real returns from real assets. And by that I mean, for the most part, real estate, both debt and equity, but also everything ranging from agricultural investments, infrastructure debt, and other real assets that are generating both income and capital gains.
Okay, and when you look at the US, you mentioned it there, bringing returns home. A part of that is because the returns aren't available in the US. So when you look at US markets, how do you see what's going on? Are there any opportunities at home?
So we absolutely believe that there are significant opportunities, and indeed we believe that the U.S. economy is in very good shape. We've actually recently upped some of our estimates for GDP growth, and we would say the U.S. is growing probably faster than its real potential GDP, which ultimately will lead to a bit of an uptick in inflation. But at the moment, we remain pretty optimistic. And I would say the most important part of that optimism is based on we see a return of business investment. Before, most of it was on the consumer side, and businesses were leveraging, but they were using a lot of that to buy back shares. In the last 18 months, that dynamic has changed. Buybacks have come well down, and we're seeing real business investment into this country. And so we like that story on the equity side. We like a lot of what that means for fixed income and higher yielding fixed income. And we remain very constructive on most aspects of the real estate sector, maybe with retail as an exception.
And on the equity side, you said earlier in the year that the stock market maybe had gotten ahead of itself in terms of betting on the success of various administration policies that might give the economy a boost. Where are we now? Obviously, a lot's changed since last summer. It seems like things are changing every day. Where are we now?
So it's a very interesting thing in terms of the market sentiment. I would say at the beginning of the year, without a doubt, there was kind of the famous Trump trade that came on, which was a belief in tax cuts and infrastructure and deregulation as a package driving growth. We saw over the first quarter and the second quarter, that trade really went to zero. I think the basic belief that that would happen diminished a great deal in investors' minds. Of course, at the same time, the real economy, sort of in a different parallel universe from politics, was doing even better. And so real growth rates were picking up. And so a general belief that the economy was doing better began to take over market sentiment. And so I would say the market was driven higher by that belief, not really related to the Trump policies. Now, in the last 2 weeks, we've started to see that shift again. And I do think that with the at least outline of a tax plan on the table, you've begun to see some of the earlier Trump trade animal spirits start to come back in. But for most of the year, I would say that really hasn't been a factor in the markets.
Okay, and we've talked about the opportunities. Where are there risks? And particularly in my conversations with investors, a lot of people talk about the Fed and there being uncertainty around, one, who might lead it, and two, whether they might raise rates too soon or move too soon. So how do you see that dynamic?
There's no question that we have real policy risk. I mean, never before in the last 30 years have we seen so much of economic activity dependent on not just the Fed, but I would generalize it to central banks around the world and the very accommodative policies. So there is a lot riding on the fact that they can begin to normalize those policies in an effective way. And that isn't just when they decide to raise rates and at what pace, but also what they do with the balance sheet. And so one of the big challenges for the Fed is going to be at what pace do they begin to unwind that balance sheet. And I think that remains one of the big risks that investors face.
One of the research notes that I received this morning made the point that monetary policy is going to dominate stock trading for the near term. Do you agree with that, or do you think that there's more to the story than that?
I think that there is quite a bit more to the story. There's no question that at today's valuation, so if you look at the S&P overall, forward Ps are about 18.5. The long-term average is more like 15.5. You could say that it looks a little bit rich. But at today's interest rates, actually it looks pretty fairly priced. But if we had a sudden rise in rates, you would begin to think probably that the current prices are without a doubt, a touch frothy. But we would not say that's the base case. We actually think the base case is that we're quite constructive on equities at the moment. But we do think that the risks of a gradual normalization remain around the balance sheet of the Fed.
Okay, and going back a step, you mentioned Bank of Japan or the Japanese market and Europe. Outside of the US, where do you see opportunity? You mentioned India as well.
There's no question. We would certainly have Japan at the top of our list. We do believe that there are large institutional investors there who are looking very actively to put their money to work outside of Japan and to move into higher yielding assets. And I would have said that their search for yield 1.0 was to move into the US and to move to kind of investment grade corporates. And we're now really seeing a search for yield 2.0, which has to do with high yield, emerging markets, and structured products, which is, we hadn't seen for quite some time from the Japanese. So I think we do believe that there is a lot more yet to run on the movement of money out of Japan.
And just turning to the money management business for a moment, the industry is changing dramatically. What's going on there, and how does the search for yield fit into that?
So the money management industry is absolutely reflecting the pressure that the clients are facing. So in this very low return environment, you think about what the big institutions are doing. Well, one, they're very worried about fees, so there's a real focus on that. Two, they're wondering, where should they pay for active management, which is more expensive than indexing, and what should they index, where they just want to buy cheap beta. And three, how many managers should they be working with? Many of them have a large roster of managers, and is that really the most effective way to manage a full portfolio? And so you're seeing that play out right now across the industry. You're seeing rationalization of managers, you're seeing fees come down for many types of products, and you're seeing the continued growth of passive.
And one of the things that people in the industry often talk about when it comes to money management is this barbell where, as you said, you have low-cost, passive, index tracking funds, and then at the other end, you have higher fee, higher active share, things like private debt, which you mentioned, and it's those in the middle that are charging higher fees for something that looks quite a lot like beta that are really going to struggle. How do you see that? Is that what we're looking at?
Yes, I very much ascribe to that. I think that firms that are charging high active share prices but delivering something that really actually hugs the benchmark are going to have a very difficult time. And I would say that's just fine. And I actually think that's competition that is leading to investors having a better proposition. I do believe investors over time will, instead of saying is it active or passive, will say how can active and passive work together so that we have cheap beta where that makes sense, but there's plenty of room to run with active management on all kinds of other strategies where you're going to need that excess return if you're going to pay for retirement over 20 years.
Sure, and in terms of those strategies that do offer excess return, which of those are you pushing into? Would there be acquisitions that might make sense to accelerate your growth in those areas? How do you see that?
Well, currently, we would say that we have most of the strategies that we need to do that. For us, we are such a big player in real assets that our real estate business in particular, both debt and equity, that's a lot of where we see excess returns coming from active management. But we would say the same thing in fixed income. We're the fourth largest fixed income business in the world, and we would say that that business is fundamentally one where active management makes a lot of sense. So for the passive piece of this, we're really just talking about equities. We think the U.S. equity markets will continue to gradually move more to passive, but we see lots of room around specialist strategies like biotechnology, senior housing type things, and we see plenty of opportunities in international and emerging markets where active management adds very significant value. Okay,
and in terms of real estate, how big an opportunity is that? You're, as you said, one of the biggest players already. Where is there an opportunity for investors to make money?
So what we're seeing from investors' point of view is a little bit of a recalibrating of their risk. So we do see demand for core going up quite a lot, and probably a little bit less in terms of demand for real opportunistic. Core Plus has also been very popular. Within the sectors, we see a very large demand for logistics, for multifamily, which has continued to be one of the important pieces. We do think hotels are probably a little bit overdone, and we've been selling in some selective large kind of gateway cities. But by and large, we still believe that the supply-demand dynamics of real estate mean there's plenty of excess returns to be had.
And you mentioned the bond market. Earlier in the year, there was definitely a sense that the stock market was saying one thing about the economy and the bond market was saying another. Where are we now, and was there a tension there, and has it been resolved?
I think that it hasn't necessarily been resolved as so much as it's come into an equilibrium. So I do think, as you put it before, that the equity market does rely on us having somewhat lower rates and the Fed normalizing policy fairly gradually. But I think if that plan does play out, you probably have a pretty even balance of risk and reward. I think the important thing to recognize about interest rates is that the Fed only really controls the short end. We believe that there is so much money looking for a home in fixed income that actually there will continue to be money that comes into the middle part of the curve and the longer part of the curve. And that's going to mean it's going to flatten. That's happened to quite a bit of degree already this year, and we would expect it to happen even more. But just because the Fed raises rates doesn't necessarily mean that will happen uniformly, and I think that's important for your viewers to realize.
Okay, well, thank you very much. That's where we should wrap up. Thanks for your time.
Thank you, Matt.
That's it for this week. Again, a big thank you to Fidelity Investments for presenting The Bottom Line.
And thank you to NASDAQ for hosting us.
Sara and I will see you next week.